Welcome, curious minds, to the Deep Dive. This is your shortcut to being truly well-informed. We cut through the noise, pull out the crucial insights from, well, stacks of sources, and maybe throw in a few surprising facts. And yeah, this Deep Dive, it's tailored just for you. So today we're tackling a really big question, and it's super timely. Is Coinbase, ticker COIN, the digital asset giant, is it genuinely set to become the foundational, everything exchange for this whole burgeoning on-chain economy? Or maybe, is that recent earnings miss a worrying sign? A sign that its most profitable days, the ones fueled by those wild retail bull runs, are actually already behind it. We're going to really pull back the curtain today, dissect every bit of the Coinbase machine, and by the end, you should have a much, much clearer picture of what's really going on. Okay, so we're diving deep into Coinbase Global Inc. The analysis date is August 1, 2025, and we'll be using its closing price from July 34, 2025, which was $377.76. And speaking of that date...
Yeah, that date, July 31st, is pretty critical because Coinbase reported its Q2 2025 earnings right after the market closed that day. And, well, it was a significant miss.
A miss? How bad?
Pretty bad, actually. Wall Street was expecting earnings per share, EPS, somewhere in the range of $0.82 to $1.19. The Zacks consensus was even at the top end, $1.19.
Okay.
And revenue. Forecasts were between $1.51 billion and $1.68 billion. But what Coinbase actually posted was an EPS of just $0.12.
12 cents? Wow.
Yeah, on revenue of $1.5 billion. So, they fell short of even the most conservative estimates out there. It really sets the stage,
Definitely. And hey, a quick heads up for you listening. If you're following this story, we'll actually be covering earnings for Coinbase within minutes of the release. So stay tuned for that. You won't want to miss it. So our exploration today is broken down into two main parts. First, we'll build that core foundation, look at the business itself, the management team, and the financials. Then we'll kind of zoom out, look at market sentiment, who owns the stock, risks, opportunities, and then wrap it all up. Sound good?
Sounds like a plan.
All right, let's jump into part one, the core foundation. Starting with chapter one, the Coinbase machine, deconstructing the business.
Okay, let's really unpack this. What is Coinbase's core mission? And, fundamentally, how does it make its money?
Right. Well, their mission it's incredibly ambitious. They state it as wanting to increase economic freedom for more than 1 billion people. Basically, building the core plumbing, the infrastructure for the whole crypto economy.
Okay, lofty goal. How does that translate into dollars?
Primarily through two different revenue streams. The first is transaction revenue. This has always been their main engine, historically. It's the fees they charge when people buy, sell, or trade crypto on their platform.
Classic exchange model.
Exactly. But the big catch here is volatility. It's directly tied to crypto market activity. So Q2 2025, for instance, that stream brought in $764 million. Sounds okay, right?
Yeah.
But that was actually a staggering 39% drop from the quarter before. Just highlights how unpredictable it is. That volatility is really what they're trying to manage, trying to escape almost. Okay, so that's the volatile part. What's the other stream?
The second one, and this is increasingly strategic for them, is subscription and services revenue. This is designed for stability, for more predictable recurring income.
Ah, okay. Like what specifically?
Things like staking earning rewards on your crypto, kind of like interest. Institutional custody fees for safeguarding assets for big players. General interest income. And really critically, revenue from the ecosystem around the USDC stablecoin.
And how is that side doing?
It's showing much more resilience. In that same tough Q2 2025, it pulled in $656 million. Now, that was still down, but only a modest 6% decline compared to the transaction side's plunge.
Yeah.
So it's definitely proving its worth as a stabilizer.
So clearly diversifying beyond just those trading fees. Makes sense. But beyond how they make money, what are the actual products and services? You mentioned an ecosystem. What does that look like?
Yeah, it's pretty comprehensive now. They've really tailored it for three main customer groups. For individuals, you've got the main trading app, of course. Then there's Coinbase One. There's subscription service, zero trading fees, other perks. The Coinbase card lets you spend crypto, earn crypto back. And the non-custodial Coinbase wallet, which is your gateway to DeFi, NFTs, all that stuff.
Okay, the retail side. What about bigger players?
Right. For institutions, they offer Coinbase Prime. That's their prime brokerage platform. Coinbase Custody, which is a huge business for them, market leader in safely keeping digital assets, and exchange APIs for programmatic trading.
And that's the third group.
Developers. This is a really crucial bet on the future, I think. They offer Base, which is their Ethereum Layer 2 network.
Layer 2. Okay, so that's about making Ethereum faster and cheaper, right?
Exactly. Think of it like an express lane built on top of Ethereum. They claim it makes transactions faster and approximately 94% cheaper than using Ethereum directly. Huge deal for usability. They also offer developers a wallet SDK and on-ramp solutions to make it easy to plug crypto into other apps.
Wow, okay. It definitely sounds like more than just another exchange. So where does that put them in the market? How big is their scale, really?
No, they're a titan, no question. Largest crypto exchange in the U.S. by trading volume.
Yeah.
The largest publicly traded crypto-focused company globally.
Right.
The scale is just immense, operating in over 100 countries, more than 4,200 employees. And those Q2 2025 numbers, $237 billion in quarterly trading volume, $425 billion in total assets on their platform.
That's staggering.
It is. And the institutional custody piece hit a record $245.7 billion. And get this, they custodian over 80% of all the assets in the US-based Bitcoin and Ethereum ETFs.
80%? Wow. So they're basically the gateway for TradFi getting into crypto ETFs.
Pretty much, yeah. It speaks volumes about the trust they've managed to build on that institutional side.
So with that scale and aiming to be this central player, what's their core value proposition? What's the brand built on?
It really boils down to two things: trust and ease of use. In a space that, let's face it, can feel complex and risky, they've consistently positioned themselves as the most trusted place for people and businesses.
How do they back that up?
Well, partly through their very public commitment to regulatory compliance, trying to play by the rules, even when the rules weren't clear. Also, industry-leading security, like keeping most assets in cold storage offline, and just a user interface that, frankly, made crypto accessible to a lot more people.
Yeah, okay, makes sense. What about the broader market? Trends, competition?
Yeah.
It's moving fast, right?
Oh, incredibly fast.
Yeah.
The overall crypto exchange market is projected to hit over $100 billion by 2028. That's a growth rate of over 20% per year. Huge potential.
What's driving that growth?
Two big macro trends, really. First is the institutionalization of crypto. We saw that with the spot Bitcoin ETF approval in 2024. That was a real watershed moment, legitimizing it for traditional investors. Second, and maybe even more impactful long-term, is the shift towards real-world utility, especially using stablecoins for business-to-business cross-border payments. CEO Brian Armstrong actually called this out as potentially a $40 trillion addressable market.
40 trillion. Okay.
That's ambitious.
Hugely ambitious. But it shows where they see the real long-term value moving beyond just speculation.
But it's not just Coinbase seeing that opportunity, right? The competition must be intense.
Oh, incredibly intense. Globally, Binance is still the biggest rival by volume. Then you've got specialized players, Kraken for experienced traders, Bybit focusing on derivatives, Crypto.com with their strong mobile presence.
And that leads to
Price wars. That race to zero on trading fees. It's a constant pressure on Coinbase's traditional revenue engine, which is exactly why that pivot to subscriptions and services is so vital for them.
Okay, so competition is fierce. But maybe the biggest change, and you touched on this, is the regulatory environment in the U.S. That seems like a massive potential tailwind for Coinbase specifically. Absolutely. That profound lack of regulatory clarity, which hung over the industry for years, pretty much evaporated in July 2025. That was a game changer.
What happened exactly?
Two major pieces of legislation finally passed. First, the Genius Act. Signed by President Trump, this set up a comprehensive federal framework for payment stablecoins, mandating things like 1.1 reserves, AML KYC checks. Huge legitimacy boost.
Okay. And the second?
The Clarity Act. This finally sorted out the jurisdictional turf war between the SEC and the CFTC. It designated the CFTC as the primary regulator for most digital assets, treating them as commodities.
So less uncertainty about who's in charge and what the rules are.
Exactly. These acts together were a monumental de-risking event, as some called it, a powerful catalyst.
Right.
And crucially for Coinbase, it validated their entire long-term strategy of prioritizing compliance. What used to be a burden is now arguably their strongest moat, especially in the U.S. market.
Right. So does that mean it's getting harder for newcomers to even enter the space now? Higher barriers to entry?
Yes, definitely. The regulatory hurdles alone are now much higher, expensive, time-consuming to get licensed, build compliance systems. Then there's security and custody building. That institutional-grade infrastructure takes billions in years to earn trust.
And the network effects.
That too. The classic chicken and egg problem. New platforms struggle to attract enough buyers and sellers to create good liquidity. Incumbents like Coinbase have a huge advantage there. The barriers are definitely getting higher.
So beyond just being big and having these barriers, what are Coinbase's specific sort of unique competitive advantages? What really sets them apart?
They have several pretty potent ones. First, brand strength. It's arguably one of the most recognized and trusted brands in crypto, particularly in the US.
All right.
Remember that Super Bowl ad with the QR code?
Yeah, it crashed their site, didn't it?
Exactly. Over 20 million visits in a minute. That's serious brand recognition. Second, cost advantages and economies of scale. Moving to AWS, for example, cut cloud costs over 60% improved scale. And their base network offering those 94% lower fees is a big structural advantage.
Okay, brand, cost, what else?
Network effects and switching costs, these are getting stronger. More users mean more liquidity, which attracts more users, a virtuous cycle. And base is key here, building an ecosystem that keeps users engaged, making Coinbase less of a simple toll collector and more like the landlord of a digital economy.
Interesting analogy, landlord.
Yeah. And finally, their unique assets and capabilities, that regulatory moat we just discussed, their institutional-grade infrastructure, dominating ETF custody, and the whole vertically integrated ecosystem, retail, institutional, wallet, their own blockchain layer with Base. It's a really comprehensive setup.
That's a very strong foundation. Okay, let's shift gears now and look at the people running the show. Time for Chapter 2, Management Evaluation. How's the leadership team performed, especially under pressure?
Well, the key figures are CEO Brian Armstrong, who's also co-founder, president, and COO Emily Choi, and CFO Elijah Haas. They've definitely proven they can scale a company, taking Coinbase public, getting into the S&P 500. That's a huge achievement for a crypto company. Yeah. But their track record on hitting quarterly financial targets is maybe less consistent. That recent Q2 miss is a pretty clear example of that ongoing challenge.
And speaking of challenges, that data breach back in May 2025, that sounds like a major test of their crisis management skills. What happened there?
Oh, it was a huge test. Basically, some overseas third-party contractors were bribed, sensitive customer data got out, and the attackers tried to extort Coinbase for $20 million.
Yikes. How did management handle it?
Their response was widely seen as pretty strong, actually. They were swift, very decisive, and notably transparent. They went public with it quickly, flat out refused to pay the ransom.
Bold move.
Yeah. And they set up a $20 million reward fund for info leading to the culprits, plus committed up to $400 million for remediation and security upgrades. So good crisis management on the face of it.
Oh.
But the incident itself obviously exposed a critical vulnerability, their reliance on those third-party contractors. It highlights that tricky balancing act they face between security, keeping costs down, and scaling quickly.
How are they generally perceived in terms of transparency and ethics, especially after something like that?
Well, they do make an effort publicly. Detailed blog posts, annual transparency reports about government data requests, clear policies on listing assets. They have formal codes of conduct.
But they've had controversies too, haven't they?
Oh, yeah. That whole apolitical stance back in 2020 caused quite a stir, led to some employees leaving, and now, inevitably, they're facing class action lawsuits related to that May 2025 data breach. So it's definitely a mixed picture when it comes to public perception and trust.
Okay. What about how they spend the company's money? Capital allocation, what's their strategy there? M&A.
CFO Elijah Haas talks about an opportunistic M&A strategy. They tend to buy for specific skills or product lines, not just for revenue. Examples are Tagomi, which became the core of Coinbase Prime, and FairX, their derivatives exchange.
Any big recent deals?
The most significant one by far was buying Deribit in May 2025. That's the world's leading crypto options exchange. Cost them about $2.9 billion in cash and stock. That acquisition is absolutely central to their plan to dominate the crypto derivatives market. Huge strategic bet.
Okay, big bet on derivatives.
Sorry.
What about returning capital to shareholders? Buybacks, dividends.
They authorized a $1 billion share buyback program back in October 2024. And they also do what some call a stealth buyback by withholding shares to cover taxes when employee stock awards vest. Both Signal management thinks the stock's undervalued, and they're confident about future cash flow.
But no dividend.
Nope, no dividend, 0.00% yield. Pretty standard for a high-growth tech company reinvesting heavily in the business.
Okay, so they're reinvesting.
Huh.
But is it actually paying off? Is Coinbase generating returns that justify those investments right now?
That's a really critical question. When you look at return on invested capital, ROIC, versus their weighted average cost of capital, WACC, well, it's not great currently.
How so?
As of March 2025, their ROIC was around 13.6%. But their WACC, the cost of their funding, is estimated to be much higher, somewhere between 19% and 20%.
So they're spending more on capital than they're earning back from it.
Exactly.
Yeah.
Right now, the company is technically not generating returns that exceed its cost of capital. That's a concern, especially for a company with such a high valuation. And historically, their ROI has been all over the place, huge in bull markets, like 145% in 2021, then deeply negative, like minus 29% in 2022. Again, tied to that crypto cycle.
All right, let's dig deeper into those numbers. Moving on to Chapter 3, financial analysis. Let's get into the nitty-gritty. What do the financials tell us?
Okay, starting with the basics. As of our analysis date, August 1st, 2025, with the stock at $377.76 and about 254 million shares out, the market cap is roughly $95.96 billion, also almost a $100 billion company.
Okay. And revenue growth. We touched on the volatility, but what's the 5-year trend look like again?
Yeah, explosive but cyclical is the story. 2020, about $1.3 billion. 2021, the peak, $7.84 billion. Then the drop in 22 and 23 to just over $3 billion. And then a rebound in 2024 to about $6.6 billion. Really shows that boom-bust-boom pattern.
A real roller coaster. How do profit margins hold up through all that?
Well, their gross margins are actually really high and pretty stable, consistently in the 87% range. That's because it's an asset-light business model, right?
Yeah.
No factories, low cost of goods sold.
Makes sense. But operating and net margins.
That's where the wild swings happen. Operating and net margins mirror the revenue volatility. Massively profitable in bull markets, like 39% operating margin in 2021, even 45% in 2024, but then huge losses in bear markets, minus 96% operating margin in 2022, minus 38% net margin in 2023, completely dependent on the crypto cycle.
So is the company actually generating enough cash to fund itself? Free cash flow.
That's also extremely cyclical. Generated over $4 billion in free cash flow in 2021, then burned through $1.6 billion in 2022. But Q2 2025 showed a positive swing back to about $328 million. So, again, highly dependent on market conditions being favorable.
And earnings consistency. I guess the answer's obvious.
Yeah, highly inconsistent, almost entirely dependent on that crypto market cycle. It makes traditional valuation really, really tricky. You can't just extrapolate past earnings.
Okay. What about their financial health? Solvency, liquidity, debt.
Their debt-to-equity ratio looked manageable at 0.40 in Q1 2025. Some past spikes were misleading because they included customer custodial funds, not actual corporate borrowing, so core debt is modest.
And liquidity, cash on hand.
Their current ratio, which measures short-term liquidity, has actually improved dramatically. It hit 2.52 in Q1 2025. This points to a very deliberate strategy to build a fortress balance sheet, gives them defense in downturns, but also firepower for things like that big Deribit acquisition. And just to confirm again, no dividend.
Okay, fortress balance sheet, volatile earnings. Let's get to the valuation.
Yeah.
How does Coinbase stack up against peers? And what's a reasonable estimate of its intrinsic value?
All right, the valuation piece is key. Their trailing PE ratio is around 71. The forward PE for 2025 is even higher, about 77. These are very high multiples, suggest the market has baked in extremely optimistic expectations for future growth.
How does that compare to similar companies?
If you look at peers like Robinhood, they're trading around 57.60 PD. Block is maybe 18.43. More traditional exchanges like CME Group are 25.28, Interactive Brokers 34.36. So Coinbase is trading at a significant premium to most of them.
Why such a high premium, do you think?
The market might be valuing it differently, not just as a brokerage, but maybe as a protocol stock, like foundational infrastructure for this new digital economy.
Yeah.
Pricing in that long-term, potentially massive opportunity.
Okay, so the market's optimistic. What does a more fundamental valuation like a discounted cash flow model suggest?
So a DCF model tries to estimate intrinsic value by forecasting future free cash flows and discounting them back to today's value. It's just one tool and highly dependent on assumptions, but
Well, what does your educational model show?
our model suggests an intrinsic value range for Coinbase of roughly $220 to $280 per share.
Okay, $220 to $280 compared to the current price of $377. That's quite a gap.
It is. It's notably lower. And for context, Morningstar's independent analysis puts their fair value estimate even lower, around $205 per share.
What are the key assumptions driving that lower DCF value?
two big ones. First, the growth rate assumptions. We used a multi-stage model, but eventually settled on a perpetual growth rate of 3.0% long term. Second, and maybe more importantly, the discount rate, the weighted average cost of capital, or WACC. We used a high WACC of 18% to 20%.
Why so high?
Because Coinbase stock is extremely volatile. Its beta is around 3.7, meaning it historically moves about 3.7 times as much as the overall market. Higher risk generally demands a higher discount rate in these models, which pushes the present value down.
Got it. High risk, high required return. Okay, let's zoom out again now. We're heading into part 2, the broader view, kicking off with chapter 4. Market sentiment. What does Wall Street really think, and what's the general mood?
Well, like we touched on with valuation, Wall Street is really divided on Coinbase. It's fascinating. You've got some analysts who are extraordinarily bullish, predicting price targets like $950, even $1,550 by 2025.
Wow, okay, that's bullish.
Extremely. Then you have the more mainstream targets clustering around a mean of about $381, much closer to the current price. And the overall consensus rating is very mixed. Lots of variation between buy, hold, and sell ratings. Zacks has it as #3 hold, basically neutral.
So a real split. What about the news flow? It feels like a constant tug of war between good news and bad news for Coinbase lately.
It really has been. On the negative side, obviously that Q2 earnings miss really hurt sentiment recently, and the May data breach definitely raised concerns about security and potential costs. Lots of negative headlines there.
But on the positive side?
The biggest positive catalyst, without a doubt, was the passage of those Genius and Clarity Acts in the U.S. That regulatory clarity was framed as an absolute game changer. Huge positive sentiment driver. Also, the announcement of that strategic partnership with JP Morgan Chase, even though it's not live until 2026, was a big boost for institutional confidence.
So despite the recent bad news, the stock held up relatively well.
Yeah, its resilience after the earnings miss suggests that, for now at least, the market is weighing that positive macro narrative, the long-term regulatory clarity and institutional adoption story, more heavily than the short-term operational hiccups.
Interesting. What about market indicators like short interest? Are a lot of people betting against the stock?
Short interest is worth watching. About 14 million shares are sold short.
Right.
That represents around 6.7% of the public float.
Is that high?
It's higher than the average for its peer group, which is around 4.5%. So yes, it indicates a slightly above average level of bearish sentiment among some traders betting the price will fall. But the days to cover is low, around 1 day, meaning there's no immediate risk of a big short squeeze.
And technically, moving averages.
From a technical perspective, the picture looks quite bullish, actually. The stock is trading significantly above both its 50-day moving average, around $324, and its 200-day moving average, around $262. Generally, that's seen as a strong signal of positive medium and long-term momentum.
Okay, mixed sentiment but strong technicals. Let's look at who actually owns the stock. Time for Chapter 5, ownership structure. Who are the big players here? Institutions.
Insiders.
Yeah, institutional ownership is significant, which is generally a good sign for legitimacy. Vanguard Group is the largest holder with over 11.4%, about 24 million shares. BlackRock is another big one, holding almost 7%, around 14.6 million shares.
Are they buying or selling? Interestingly, both Vanguard and BlackRock recently increased their positions. That signals growing confidence from these massive, influential asset managers.
Okay, big institutions are buying. What about insiders, particularly the CEO, Brian Armstrong? I hear he's been selling.
That's a really interesting dynamic. Yes, Brian Armstrong is still the largest insider shareholder, holding around 14% or 33 million shares as of early 2025. But he has been a consistent and pretty significant seller throughout 2025.
Why is he selling if the big guys are buying?
Well, these sales are done through pre-arranged 10b5-1 trading plans set up in advance. It's common for founders of mature public companies to gradually diversify their holdings. Other executives are also regular sellers. Over the last year, insiders collectively sold almost 1 million more shares than they bought.
So what's the interpretation?
You could see it as a passing of the baton. As the company matures, ownership naturally shifts from early insiders to a broader base of institutional investors. It doesn't necessarily mean insiders lack confidence, more that their personal financial planning is kicking in.
But they still have control, right? Those special shares.
Right. Even though insiders hold a relatively small percentage of the total shares now, founders like Armstrong retain significant voting power through their super voting Class B shares. So they still effectively control the company's direction.
Okay, that makes sense. So pulling all this together, the business, management, financials, market, ownership. Let's talk risk. Chapter 6, risk assessment. Let's use a SWOT analysis. Strengths, weaknesses, opportunities, threats.
Okay, SWOT time. Let's start with strengths. We've hit these, but to recap, powerful brand and trust, especially in the U.S., that newly solidified regulatory moat thanks to U.S. legislation, clear institutional dominance, particularly in ETF custody, 80% market share, their integrated ecosystem retail, institutional wallet, base L2, and that fortress balance sheet with over $9 billion in cash and equivalents.
Solid strengths. What about the weaknesses?
The big one is still revenue volatility, just inherently tied to the unpredictable crypto market. Operational risk and internal controls, that May 2025 data breach, really damaged their reputation for trust, didn't it? Their high fee structure is still a vulnerability in the face of intense competition. And, as we discussed, that inefficient capital allocation currently, with ROIC below WACC, suggests they're not yet consistently generating value for shareholders on new investments.
Okay. Plenty to work on. What about the opportunities?
Huge opportunities. That U.S. regulatory clarity potentially unlocks massive growth in stablecoins, tokenized assets. The payments revolution, Armstrong talks about that potential $40 trillion B2B cross-border market using stablecoins. Growing the derivatives market via the Deribit acquisition, really monetizing the base ecosystem, finding new high-margin revenue streams beyond just cheap transactions, and continued global expansion, like getting their MiCA license in Europe.
Lots of potential upside, but there are always threats.
Right.
Right.
Absolutely. Intense global competition driving that race to zero on fees is a constant threat. The inherent crypto market cycles, a prolonged bear market, would obviously hurt them badly. Persistent cybersecurity threats, they're a massive target for hackers. Macroeconomic factors, things like high interest rates, can pull capital away from risk assets like crypto, inflation concerns, and even geopolitical factors like those U.S. tariffs introduced in 2025, creating uncertainty, driving a general risk-off sentiment that tends to hit speculative assets.
That's a comprehensive picture. Okay, we've covered a ton of ground. Let's bring it all together in our final section. Chapter 7. Conclusion. Time to synthesize and lay out the bull and bear cases. What's the core argument for the bulls?
The bull case, in a nutshell, is that Coinbase is successfully transforming itself. It argues they have a solidified regulatory moat, making compliance their key advantage now. They're making a strategic pivot to stable revenue via subscriptions, USDC, and derivatives, reducing reliance on volatile trading. They're building powerful ecosystem lock-in with base L2, creating network effects and new revenue streams. And they remain the undisputed institutional leader, the trusted gateway for big money entering crypto. Bulls see them becoming indispensable infrastructure.
Okay, that's the optimistic view, but there's always another side, isn't there? What's the bear case?
The bear case focuses on valuation and execution risk. Key points. First, an extreme valuation. The stock price seems to bake in flawless execution, but the current ROIC doesn't justify that premium. Second, operational fragility and a trust deficit. That May 2025 data breach exposed real weaknesses and hurt their core brand promise of trust, potentially causing lasting damage. Third, persistent fee compression. Trading fees are still significant and competition keeps pushing them down. And fourth, they remain somewhat hostage to macro forces. A crypto winter or a broader risk-off environment would still hit their business hard, regardless of diversification efforts.
And just to restate that valuation summary from our model, our educational discounted cash flow analysis suggested an intrinsic value range of $220 to $280 per share.
Right. So as of today, August 1st, 2025, with the share price at $377.76, Coinbase is trading at a significant premium to that estimated intrinsic value range. It really implies the market is pricing in much more optimistic assumptions about future growth and profitability than our model reflects. Ultimately, an investment in Coinbase at this price is a high-conviction bet. It's a bet that they will successfully become that indispensable protocol-level infrastructure for a massive on-chain economy, and that they'll monetize that position at very high margins for a long, long time. The current share price leaves very little room for error in executing that vision.
So a final thought for you, our listener. What stands out to you? Is Coinbase's big bet on becoming the digital economy's landlord going to pay off? Or will the inherent volatility and execution risks always keep it on a precarious edge, something to keep mulling over as you continue your own learning journey? And that wraps up this deep dive into Coinbase. Hey, if you found this analysis valuable, please do us a favor, like this video and subscribe to the Stock Analytics AI YouTube channel. And remember, for just $4.99 a month, Stock Analytics AI members get priority access to deep dives like this one. Over the next few months, we're actually covering all of the S&P 500 stocks, and members get exclusive priority access to those. Want a one-off deep dive on a stock you pick? Just drop us a super thanks on the video. And one last time, don't forget, stay tuned because we will be covering earnings for Coinbase within minutes of their release.
And just the standard disclaimer, This analysis was generated by an AI system purely for educational purposes. It should definitely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Thanks so much for joining us on the Deep Dive. We'll be back soon with more insights to help you stay well informed.